Testing, testing, testing. Okay, cool. All right, we are live. Okay, make sure everything's good to go before I start. Cool. What's going on, guys? So this is day 5 of studying for the FAR section of the CPA exam using my own personal CPA prep tool that I've made called CPAcioli. Kind of like our little mission statement or our call or whatever, CPA Exam Prep you can actually afford. And so basically, yeah, we are doing FAR section. Before I start, I need to send this real fast. Right. Yeah, this is exciting. So I'm finally starting to get a few viewers. Sorry, I'm make sure. Yeah, I'm being so nervous about this right now because basically yesterday my webcam randomly cut off, or the screen share part cut off, and I had no clue. So I was talking to myself for like 40 minutes and I was super frustrated because it actually happened both times. The first time is because the power went out because lightning struck, and the second time was I have no clue. So because of that, I'm going to keep these to an hour. So I am going to do around an hour of these study sessions and then cut it off because that's most people's attention spans anyway. So we're still going to try to get through 50 questions, but we're going to go a little faster this time. And I'm going to check over here occasionally just to make sure that it still says it's sharing, because it was even showing it on this screen that it was sharing, but it wasn't. And so I was talking to myself and it was sad. But yeah, I'm excited. I've been getting a few questions on my app now, people, just saying it's cool or whatever. So that's really exciting. So I'm going to keep doing these, and I hope you all continue to join the lives. I think it's a really good, accountability thing if you're studying for the CPA exam. Also, I'm going to open up a Discord soon so that we can kind of form a community around this. I think that would be a really big help to people, including myself, who's also studying for the CPA using this. So a lot of things are in store, but I'm really excited for this. I got some lo-fi on today for some good background noise that might help people, study. So yeah, let's get right into it. Before I begin, let me check one thing. All right, we are ready to go. So I will sign in and get started. Thanks for tuning in. And like I said, let me know if you have any questions. And we're going to knock this thing out. Before I start, let me take some real fast. Okay. All right, let's get into it. So we're going to go multiple choice. We're going to go unanswered questions like we've been doing, all difficulty and all sub areas. Once again, here are the sub areas. And let's begin. And soon I'm going to add a timer to this just so people can keep track of how much they practice better. And it'll show up on the stats, but I also want to add a timer to this so that you can see per session how much you're actually studying. And let me know if y'all like the lo-fi background music or whatever you like or dislike about this, because I'm trying to make these streams as entertaining as I can. I'll also try to start going a little faster off the rip rather than checking my phone. Just a few things came up, but like I said, I want to keep these around an hour in length, so around a minute per question, so we can just knock these out and get more sessions in. So let's get going. Our company pays legal and due diligence fees of $50K and separately incurs $10K of stock issuance costs related to shares issues as part of the consideration transferred. So I think you would expense the $50K as incurred, and you would charge the $10K against the stock proceeds, maybe. Yeah, because the legal fees, I remember, are expenses incurred, and then you charge the $10K against the stock proceeds. And like I said, I'm mainly going to read these if I get them wrong, but if I get them right, I'm kind of just going to go past them pretty fast so we can keep these around an hour in length. All right. And don't forget to utilize the star feature if you have a question about one, so that it'll save to your account and you can go back to it later. An available for sale debt security held by a company will mature in 18 months from the current balance sheet date. Should be non-current. Yeah, because it's more than a year. 18 months is more than a year. Pretty simple. Company purchased equipment for $130K with an estimated salvage value of 10. Okay. Some of the year's digits. Dang. Because I was going to say straight line, this would be easy. Was the depreciation expense for year 2? Let's see here. Okay. So you subtract the salvage value out, but okay, so I believe it would be so 4 years. So I think you would for year 2. So I believe the denominator is the sum of the years into the name. So 1 plus 2 plus 3 plus 4 would be 10. Yeah. And for year 2, let's see. Year 2 would be 2, or does it go backwards? It might go backwards, actually. So first year would be 4 divided by 10. Second year would be 3 divided by 10, which is 30%. Subtract, so 120,000 times 0.3. 36,000, I believe. Okay, nice. And so remember, it counts down. So the first year would be 4 out of 10. The second year would be 3 out of 10. Yeah. Cool. And you still subtract the salvage value out. 100%. Let's go. And I kind of keep this because you have to get a 75 to pass. So basically at the end of every session, if you get over a 75, theoretically, you'll be able to pass. But you want that consistently, obviously. And feel free to let me know of any questions in the comments as well, and I'll respond to them. Net income 2. Okay, this is an indirect method question. So once again, you do the opposite of what you would do to get the cash amount. So opposite of what you think it would be to get the cash amount. So net income of 200, and then probably do this in my head. Depreciation expense of 30K. So you would add that. So 230. Amortization of bond discount. Crap. I'm not sure about the bond discount one. Let's see. So I'm going to skip that one for now. So 230, increase in accounts receivable would be decrease in 18. So 230 minus 18 is 212. Decrease in prepaid expenses would be added because prepaid expenses are assets. 217. Decrease in accounts payable 207. Gain on the sale of investments of 12. Gain 207 minus 12. 197. 195. 202. Report. On discount. So I got 202 before the amortization. I think you would, I guess, add it. I'm not sure. This one's tough. Okay, so you would add the amortization of bond discount. Let's see why. Okay, so you'd add the amortization of bond discount. So amortization of bond discount in order to be less. That's why you add it. Okay, so you would add the amortization of bond discount. So if there's amortization of bond premium, then you would subtract it. Cool. That one's confusing, but we got it. Let's go. Donates land with a fair value of $200K to a corporation to induce it to build a facility in the area. Maybe C. Nice. So record the land at its $200,000 fair value, crediting donated capital, contribution revenue, or additional paying capital. Okay, so land is a debit, and donated capital or contribution revenue is a credit. Awesome. Lacey makes $60,000 of permanent improvements to office space and is dropping lease for the remaining lease term of 6 years. That's a good question. It's either A or B, I'm assuming. I think it's A. The shorter the remaining lease term or the improvement's useful life. Nice. Okay. So they're amortized over the shorter their estimated useful life of the remaining lease term. So leasing generally will not benefit from the improvements beyond the lease term. Makes sense. Yeah. Cool. Wow, 100% accuracy still. Let's go. Lacey has a finance lease with an initial lease liability of $300 and an implicit interest rate of 7%. Okay. So let's do 300,000 times 7%, 21,000. Sorry, I need to know these. They're easy. I do them a lot, but okay. 300 times 7% is 21,000. What does that have to do with? I think it's either A or D just from process of elimination, but I need to see why. Year one payment has been applied. All right. Yes. Okay. Let me explain this. So I did 300,000 times the 7% is 21,000. Then I did 65,000 minus the 21,000, which is 44,000. Then I subtracted the 44,000 from the 300,000 to get 256,000. Then I multiplied that number by the 7% to get D. So, beginning liability balance, interest expense, payment, the principal reduction is the difference of the two. And so that's the ending liability balance in year one. So then you multiply by the 7% for year two and get the interest expense. Cool. Awesome. Under the FASB consensual framework, which fundamental qualitative characteristic requires the financial information be free from material error? Should be this. Yep. Just something you got to memorize. Which measurement, focus, and basis of accounting are used to prepare the financial statements for governmental funds? Governmental funds. I know governmental funds and government-wide financial statements are confusing because they sound so similar. Governmental funds are modified accrual and current. Yeah. Cool. Just something you got to memorize. And then government-wide financial statements use economic resource measurement focus and full accrual basis. But governmental funds use current financial resources measurement focus and modified accrual basis. Yep. Company has inventory that costs 45, estimated selling price is 50, estimated cost complete, and sell the inventory of 3. Under the lower of cost or net realizable value rule. What amount should this inventory be reported? cost, I think, would be $48,000, and the net realizable value would be $43,000. So I think it's A. Interesting. Okay, the net realizable value is $47,000. Okay, so I guess net realizable value doesn't factor in profit margins, so 47, and then the cost is just 45. I guess the estimated cost to complete, and so the inventory aren't included. Under the simplified lower of cost or net realizable value rule, applicable to inventory measuring methods other than lifestyle retail method. Inventories report the lower of cost or net realizable value. Net realizable value is estimated selling price less reasonably predictable cost of completion and disposal. Okay. Yeah. There's $47,000 and the cost is just the $45,000. I thought you might add that to the cost, but I guess not. The normal profit margin is not a factor in this simplified rule, unlike the lower cost or margins rule for calculation. Okay. So estimated selling price less cost to complete and sell. That's the net realizable value. And the cost of $45,000 does not include the estimated cost to complete and sell the inventory. Therefore, it's lower, so it should be $45,000. Cool. A legally separate organization for which the elected officials of a primary government are financially accountable. Fiscally dependent on the primary government. That is fiscally dependent on the primary government. Don't remember. Okay, nice. Barely remember that, yeah. A legally separate entity for which the primary government is financially accountable is a component unit. But either blended or part of the primary government or discretely presented separately. Cool. Just something you gotta remember. Basis reflects the amount of cash or equivalent paid to criminals at the time of its acquisition. Should be historical cost. Cool. A donor promises to give a not-for-profit $100K if the organization raises matching funds of $100K from other sources, and the condition has not yet been satisfied at year end. Should be C. It's not recognized as receivable revenue because the matching requirement is a barrier not yet overcome. Yep. Because the promise is contingent on overcoming a measurable barrier, raising matching funds that has not yet been satisfied at year end, no receivable revenue is recognized under ASC's conditional contribution guidance. Sub company previously issued 500K face value bonds. Currently carried in subs books at 480. Okay, consolidated financial statements. So who's the consolidated entity here? Two outside parties. I don't know if sub company or if it's parent. So I feel like it would be a gain of 20,000 for the parent, but a loss of 20,000 for the sub. I guess I'm thinking it's parent, which would mean it's a $20,000 gain. Nice. When one member of consolidated group acquires the debt of another member from outside third parties, the consolidated entity treats the debt as constructively retired, recognizing gain or loss equal to the difference between the debt's carrying amount on the issuer's books and the price paid by the affiliate to acquire it. Price paid by the affiliate to acquire it. Although neither parent nor sub records a gain on separate entity books at the time of purchase, the consolidating elimination entry is needed to recognize the 20,000 gain in the consolidated financial statement, since from the consolidated perspective the debt has effectively been extinguished. All right. Who's the key factor that distinguishes an unconditional promise to give from a conditional promise to give? Unconditional promise to give from a conditional promise to give. Yeah, it should be that. Yep. Measurable barrier. An entity elects the fair value option for a specific eligible financial asset. Changes recognized in net income. So once made, the selection is irrevocable for that specific instrument, preventing selective reversal. 94%, let's go. Which basic accounting assumption presumes that an entity will continue to operate for the foreseeable future? Going concern. Just got to memorize it. The present value measurement. The following best which is the expected cash flow approach from the traditional present value approach. Yeah. The expected cash flow approach incorporates uncertainty in the cash flows themselves and discounts at a risk-free adjusted rate for time value only, while the traditional approach embeds risk entirely in the discount rate applied to a single best estimate cash flow. And discounts using a rate that isolates the time value of money. Like the traditional approach, which embeds risk in the rate. Like the traditional approach, which embeds risk in the rate. During the year, parent sells inventory to its wholly owned sub. At a markup of 25% on cost. Maybe 10,000 because the 25% on cost. I think it would just be 10,000 profit, but I'm not sure about tax rates and such, but I'm gonna go 10,000. 8,000, interesting, okay. Because the markup is stated as percentage of cost, profit embedded in the transfer price is a smaller percentage than the transfer price itself. Profit remaining in based on the gross profit percentage of the transfer price, not the cost based markup percentage. Given markup on costs. Okay, 25% on cost markup equals 20% of the transfer price. Okay, let's see how. Okay. Because a markup of 40,000 25 is 10,000. And then do the percentage, so it would be 10,000 divided by the profit plus the cost, which is 50,000, which is 20%. And then divide 20% times 40,000 to get 8,000. Confusing, but makes sense. Adding a calculator on here. All right, that makes sense. Investor holds a 50% interest in a joint venture with another company. Under U.S. GAAP, how should the investor totally calculate this joint venture interest? Yeah, using the equity method, since joint control precludes consolidation and typically conveys significant influence. Which of the following best distinguishes comparability from consistency as quantitative characteristics of useful financial information? Comparability from consistency. Yeah, pretty common sense there. Awesome. He has both the power to direct the activities of a variable interest entity Power to direct the activities of variable interest entity. The obligation to absorb losses with your right to receive benefits. Be significant to the Nice. A reporting entity that holds both the power to direct most significant economic activities and exposure to potentially significant losses. A not-for-profit resource recipient receives cash from a donor with not-for-profit resource recipient receives cash from a donor with instructions. The recipient has no variance power and is not financially interrelated with the specified beneficiary. It acts merely as an agent or intermediary and records a liability to the beneficiary rather than contribution revenue. Records a liability to the beneficiary rather than contribution revenue. Okay. Makes sense. Yeah, I just didn't read it well enough. Agency transaction, liability to beneficiary, not contribution revenue. Financially related with the beneficiary, so it should be liability. Yeah. Yeah, that makes sense. Acquirer company previously held a 15% non-controlling equity interest in target company, accounted for as an equity security at fair value with a carrying amount of 90. Cash. Should acquire recognizing the previously held interest as a result of obtaining control. Oh man, let's see. I'm assuming it's at acquisition date, so maybe a $15,000 gain, recognizing net income. Cool. In a step acquisition, the acquirer remeasures any previously held equity interest to its acquisition date fair value and recognizes the resulting gain or loss in net income. In this case, it was a gain. With $15,000 excess, it rates $90K. Carrying amount recognized as a gain in net income. A not-for-profit entity's statement of activities reports the change in net assets for the period resulting from revenues, expenses, gains, and losses. Yeah, I think statement of financial position is like a balance sheet for not-for-profits, and statement of activities is like an income statement for not-for-profits. Nice. right, halfway done. I think we're looking good. A little bit over time for sure, but looks like we're still recording, so that's good. Might actually do 30 this session because we want to keep it at an hour. So I'm thinking about doing 30 and then, maybe doing another one more frequently just to keep them in an hour apiece. That could be the move. Yeah, because FOB shipping point is when the goods are shipped. And then the FOB destination would be only when the goods are received by the buyer at the buyer's location. But this is shipping point, so it's C. The city's general fund issues $500,000 of long-term general obligation bonds under modified rule of accounting. How should the general fund proceed with liability? The proceeds are another financing source in the general fund. The liability is reported only in the government-wide statement of net position. Under modified accrual accounting, governmental funds report only current financial resources and current obligations. Bond proceeds appear as another financing source, while the long-term liability belongs solely at the government-wide level. So general fund, modified accrual, other financing source, not reported, not a current obligation, government-wide statement, full accrual, increases cash reported as long-term liability. So the proceeds are an other financing source in the general fund. The liability is reported only in the government-wide statement of net position. So bond proceeds flow into the general fund as another financing source, not revenue, and the related long-term obligation is recognized only in the government-wide statement. Related long-term obligation is recognized only in the government-wide statement of net. Define government-wide statement of net position under full accrual. Okay, makes sense. Just something you gotta memorize. Clearwater Corp, a U.S. entity, purchases inventory from a German supplier for 100,000 euros. The exchange rate is $1.10 per euro. At year-end, the payable was still outstanding. The exchange rate has risen to that. So it should be 115,000. Translate the current year in spot rate. It's unrealized, so I think it would be other comprehensive income. Yeah, I think foreign currency things are in other comprehensive income. Let's see. Dang. Okay, why? Dang. Translate the current year spot rate. $5,000 increase is a foreign currency transaction loss recognized in net income. Thought it would be recognized in other comprehensive income. Foreign currency monetary items such as payables are remeasured at the spot rate at each balance sheet date. And the resulting gain or loss is recognized immediately in net income. Although the $115,000 remeasured balance is correct, recording the $5,000 difference in other comprehensive income is wrong. OCI treatment is reserved for translation. Okay. For translation adjustments of foreign subsidiaries, not transaction gains and losses on monetary items. Okay. Reserved for translation adjustments of foreign subsidiaries, not transaction gains and losses on monetary items. All right. Dang, I thought I was onto something there, but I was not. All right, 2 more for this session. We'll end this session. We're going to start doing them in 30 so that we can do an hour apiece. And I think that'll be better just to make sure everything's working and not bore y'all for 2 hours straight. So we'll do 30 questions, which will be around an hour, which is around 2 minutes a question, which I like better than doing it for 2 hours. So, yeah. And if it in cash, additional shares, value of that to acquire that. So that would be a total of $1 million. Assuming just goodwill, let's see. A bargain purchase gain of $300,000 recognized in earnings from the acquisition date. Let's see why. When net identifiable assets acquired exceed total consideration transferred after reassessing that all assets, liabilities, and consideration are correctly measured, requires the excess to be recognized as a bargain purchase gain in earnings on the acquisition date. Goodwill arises when consideration exceeds net identifiable assets. Goodwill arises when consideration exceeds net identifiable assets. Okay, here the reverse is true. Okay. When consideration exceeds net identifiable assets, here the reverse is true, indicating a bargain purchase gain, not goodwill. So 1.3 of net identifiable assets minus 1. when total consideration equals $300K after reassessing that all assets, liabilities, and consideration are correctly measured. Requires the excess to be recognized as bargain purchase gain and earnings on the acquisition date. Okay, cool. And then one more. That's hard. Let's get it right. We can get our accuracy to 80%. A lessee has an existing operating lease with a remaining lease liability, $200K. Lease modification that increases the scope of the lease by adding additional lease space, and the additional consideration for the added space is not commensurate with the standalone price. Price below. Lease modification. Thinking maybe C, but let's see. I'm thinking probably C. It's either C or D. I'm thinking C because it increases the scope and it's not commensurate with the standalone price. And because of that, I feel like it's separate. Guess not. Account for it as a modification of the existing lease, not a separate contract, remeasuring the lease liability and adjusting the ROU asset. A lease modification is accounted for as a separate contract only if it grants an additional right of use not included in the original lease and the additional consideration is commensurate with the standalone price of that additional right of use. If the additional consideration is not a standalone price, I guess it would have helped it out if I know what commensurate means. Modification is instead accounted for by remeasuring the existing lease. Because the additional consideration for the added space is not priced as its standalone selling price, the modification fails a separate contract test and must instead be accounted for by remeasuring the existing lease liability right of use asset. Good to know, though. All right, that is the 30 answered questions. So, yeah, I'm going to start doing 30 so we can get about an hour per streaming session. Let's see where we're at right now. Hour and 5, yeah. So, yeah, I'm going to start doing that. Let me know if you have any questions. Once again, 7-day free trial, no credit card required. And then after that, it's going to be $19 a month, or you can pay yearly if you want it cheaper per month. Once again, that's day 5 of studying for FAR, using my own study tool that I've made. And yeah, I hope y'all like the UI and everything. Let me know if you have any questions or concerns, and I will see y'all next time. Y'all have a good one. Peace, guys. See y'all next time.